I need you to hold two completely contradictory facts in your head simultaneously. Because these two facts, existing at the exact same moment in the exact same market on this Sunday morning, May 17th, 2026, are the most important signal this precious metals market has sent since the war began in February. And the investors who understand what this contradiction means are going to make a very different decision this week than the investors who only see one side of it. Fact 1. Gold is at $4,183, its lowest level since March 2026, down 5.2% over the past 4 weeks, down from the highs near $4,750. Silver dropped more than 10% in a single trading session on Friday, 10% in one day. The gold-silver ratio reversed from 53 to 59 in 24 hours, one of the sharpest single-session ratio reversals in modern precious metals history. UBS just slashed its silver supply deficit estimate from 300 million ounces down to 60 to 70 million ounces, a 75% reduction in one analyst report. Markets have fully priced out any Federal Reserve rate cut this year. Traders are now wagering on a December rate hike, the new Fed chair. Kevin Warsh, one of the most hawkish central bankers of his generation, was just confirmed by the Senate. 5 simultaneous bearish forces hitting the same market at the same time. The paper price is telling you one story, and that story is ugly. Fact 2. Physical bullion dealers across the United States are reporting firm premiums and steady accumulation at sub-$4,600 gold levels. Not panic selling, not investors liquidating their physical positions alongside the paper market collapse. Buying. Physical gold bars and silver coins changing hands at premiums above the spot price. Premiums that widen, not narrow, when paper prices drop. The people who hold the actual metal, who store it in their vaults, who buy and sell physical bars and coins to real human beings making real investment decisions, those people are seeing demand increase as the paper price falls. The physical market is voting with its wallet in the exact opposite direction of the paper market. Today is Sunday, May 17th, 2026. Asian guy here. And what I need to walk you through right now, with the precision this moment deserves, is exactly what the divergence between a crashing paper price and a strengthening physical market is telling you. Because this divergence is not new. It has appeared at specific, documented, historically verifiable moments in every major precious metals bull market of the modern era. And every single time it has appeared, it has marked the same thing. Not the end of the bull market, the bottom of the correction. The moment where the paper market's short-term mechanics have pushed the price below the level where physical buyers, the buyers who do not use leverage, who do not face margin calls, who are accumulating because they understand the structural thesis, begin absorbing supply with a conviction that eventually overwhelms the paper selling. Let me show you the engine, because the paper price is the exhaust, and the physical market is the engine. And right now the engine is telling you something that the exhaust is completely failing to communicate. Let me start with the paper price crash, because you cannot properly evaluate the physical market signal without first understanding the precise mechanical nature of what drove gold down 5% in 4 weeks and silver down 10% in a single session. Because the mechanism matters enormously for determining whether this is a structural change in the precious metals thesis or a temporary paper market clearing event. 5 forces hit the precious metals paper market simultaneously this week. Each one individually would have been enough to create selling pressure. Together, arriving in the same 5-day window, they created the kind of cascading forced selling that moves prices far below where fundamental buyers would willingly sell. The first force was the CPI and PPI data. April CPI printed at 3.8%. The highest since May 2023. April PPI surged at its fastest pace since early 2022. Both prints exceeded expectations. Both confirmed that the inflation driven by 10 weeks of Strait of Hormuz disruption has fully embedded itself in consumer and producer prices. The market's reaction was immediate and mechanical. Rate cut probability went to 0. Rate hike probability for December moved to 50%. Treasury yields spiked. The dollar strengthened. And the algorithmic trading systems that monitor these variables in real time began selling precious metals futures automatically, not because a human being made a judgment that gold and silver were overvalued, but because the rate environment signals that the algorithms are programmed to respond to changed in a direction that their models associate with precious metals weakness. The second force was the new Fed chair confirmation. The Senate confirmed Kevin Warsh as Federal Reserve Chair. Warsh is one of the most hawkish central bankers of his generation. A man who has publicly argued that the Fed's credibility depends on its willingness to raise rates aggressively when inflation exceeds target. His confirmation in the same week that CPI and PPI came in hotter than expected is not a coincidence. It is a signal that the political decision makers in Washington have concluded that the inflation problem is serious enough to require more restrictive monetary authority than the previous chair was willing to be. Managed money funds that follow Fed leadership transitions updated their rate outlook models in real time, and their models said, sell gold, sell silver. The third force was the Trump-Xi summit outcome. The summit produced no substantive deal on tariffs, rare earths, or AI supply chain cooperation. Xi warned that disputes over Taiwan could strain relations and risk conflict. The industrial demand signal that drove silver's 6% surge on May 11th, the one we discussed in detail on this channel, the one that compressed the gold-silver ratio from 61 to 55 in 4 weeks, partially reversed. The managed money funds that had bought silver on trade, optimism unwound those positions when it became clear that the summit had not delivered the manufacturing confidence signal that the industrial demand thesis required. The fourth force was UBS's forecast revision. Swiss bank UBS slashed its full-year silver investment demand estimate from over 400 million ounces to 300 million ounces. More devastatingly, UBS cut its silver supply deficit estimate from 300 million ounces to just 60 to 70 million ounces, a 75% reduction in the projected annual imbalance between supply and demand. That revision, from a major bank with significant precious metals research credibility, hit the silver market like a freight train. Investors who had been long silver based on the supply deficit thesis suddenly had a major bank telling them the deficit was 75% smaller than they thought. Forced selling, stop losses triggered, margin calls on leveraged positions. The 10% single-session drop in silver on Friday was the paper market processing the UBS revision with the mechanical brutality that leveraged futures markets always show when a major fundamental assumption gets challenged. The fifth force was the India tariff hike. India raised import tariffs on gold and silver from 6% to 15%. India is the world's second largest gold consumer and a significant silver market. A 9 percentage point tariff increase is a direct demand shock for a major consuming nation. It raises the effective price of physical metal for Indian buyers, reducing volume and creating a demand headwind that the global supply-demand models now have to incorporate. 5 forces, each one real, each one creating genuine selling pressure, and together producing the paper price action you're watching right now. Gold at $4,183, silver at $76, ratio at 59, premiums to fair value destroyed. Now, let me walk you through the physical market signal, because this is the half of the story that the mainstream financial media is not telling you. And it is the half that matters most for understanding where this market goes from here. Physical bullion dealers across the United States are reporting firm premiums and steady accumulation at sub-$4,600 gold levels. Let me be precise about what this means in market structure terms, because the language matters. When paper prices drop sharply, when COMEX futures fall 5% in a week driven by algorithmic selling, margin calls, and forced liquidations, the normal behavior of retail precious metals investors is to panic. To assume the paper price drop reflects a genuine deterioration in the fundamental value of the metal, to call their dealer and ask whether they should sell, to lock in losses rather than watch them deepen. This behavior is what you would expect from investors who bought the momentum and are now watching it reverse. What is actually happening is the opposite. Retail investors are calling their dealers and asking how to buy more. They are seeing sub-$4,600 gold, a level that was considered cheap just 6 weeks ago when gold was on its way to $4,150, and deciding that the paper market has created a discount that the physical market does not validate. They are buying bars and coins at premiums above the spot price, paying more than the COMEX paper price to get their hands on actual physical metal, because the physical supply at dealer level is tight enough that you cannot simply walk in and take delivery at the paper price. That premium widening is the most important data point in this entire market right now. It is telling you that the physical demand at current price levels is strong enough that dealers cannot source supply fast enough to meet it without charging above the paper price. And physical premiums that widen while paper prices fall are the signature of a market where the paper selling is creating a discount relative to physical reality, not a reflection of genuine supply excess or demand destruction. Now, let me connect this to the historical record, because the current divergence between paper prices and physical premiums has appeared before at specific documented moments in precious metals history. In 2008, during the peak of the financial crisis, gold paper prices dropped sharply as institutional investors liquidated everything to meet margin calls. Physical gold bars and coins virtually disappeared from dealer shelves. The U.S. Mint suspended sales of American Gold Eagles because it could not source blanks fast enough. Premiums for physical gold over the paper COMEX price reached 10% to 15%. And from the bottom of that paper market crash, with physical dealers sold out and premiums at their widest, gold rallied from approximately $700 per ounce to $900 per ounce over the following 3 years. The physical shortage at the paper price bottom was the signal, not the paper chart. In 2020, during the COVID panic, silver paper prices crashed to $12 per ounce in March. Physical silver dealers reported complete inventory sellouts within days. Premiums for physical silver eagles reached 50% to 100% above the spot price. Retail investors who tried to buy physical silver at the COMEX paper price found it was simply unavailable. And from that $12 paper market bottom, with physical dealers completely sold out, silver rallied to $29 in 6 months and eventually to $30 in 2021, before the current bull cycle took it to $121 earlier this year. The pattern is consistent and historically documented. Paper price crashes that coincide with physical dealer inventory tightness and premium widening are not signals of the end of a bull market. They are signals of a paper market that is temporarily disconnected from physical reality. And the reconnection, the process by which the paper price catches up to the physical premium signal, is the recovery move that follows every paper crash at a physical supply bottom. Now, I need to address the UBS revision directly because it is the single most impactful bearish data point of the week, and every serious silver investor needs to understand whether it changes the structural thesis or whether it is the kind of analyst revision that gets made near market bottoms and subsequently gets reversed. UBS cut its silver supply deficit estimate from 300 million ounces to 60 to 70 million ounces, a 75% reduction. That is an extraordinary revision. And here's the critical question. What changed in the supply-demand fundamentals that justifies a 75% reduction in the projected annual deficit? The answer UBS gave involves two components. First, weaker industrial usage. UBS is projecting that the combination of hot inflation, rate hike fears, and the Iran conflict's drag on global manufacturing activity will reduce silver's industrial demand more significantly than previously modeled. Second, increased mine supply. UBS is seeing higher than expected production from primary and byproduct silver mining operations, particularly from Mexico and Peru, where production has surprised to the upside in early 2026. Both of these inputs are real. Industrial demand does soften when recession fears rise. Mine supply does occasionally surprise to the upside when high prices incentivize additional production at marginal operations. UBS is not making these numbers up. But here is what you need to understand about analyst demand revisions made in the middle of a volatile, news-driven market move. They are almost always directionally correct in their identification of the headwinds, and almost always excessive in their quantification of the impact. When CPI is running at 3.8%, when the Fed is talking about rate hikes, when the Trump-Xi summit produced no deal, in that environment, an analyst building an industrial demand model will apply conservative assumptions to every variable. They will assume the solar build-out slows more than the deployment data actually shows. They will assume EV production growth decelerates more than the order book data actually implies. They will assume AI CAPEX gets cut more than the hyperscaler earnings calls actually suggest. The model outputs a 75% reduction in the deficit. And the model is built on assumptions that reflect the most bearish possible reading of every input variable simultaneously. But here's the thing about the underlying demand drivers. Solar deployment data for 2026 is not showing a 75% reduction in silver consumption from solar panels. AI CAPEX commitments from Meta, Alphabet, Microsoft, and Amazon are not being canceled. They are being increased. EV production globally is not falling. It is growing. The structural demand story has not changed by 75%. The model assumptions have changed by 75% in response to a specific macro environment that may not persist for the duration of the period being modeled. And here is the historical precedent for this specific type of analyst revision. In late 2008, multiple major banks made dramatic downward revisions to gold and silver demand forecasts in the middle of the financial crisis paper price crash. Goldman Sachs cut its gold price forecast to $700. Those revisions were made at the exact bottom of the paper price. They were subsequently reversed as the physical market's buying signal proved more durable than the paper market's selling signal. The analysts who made the bottom of market revisions were not wrong about the short-term headwinds. They were wrong about the persistence of those headwinds relative to the structural demand drivers that had been building for years. UBS's 75% deficit revision may be the same kind of bottom of market revision that gets partially or fully reversed when May CPI, the first inflation print that captures oil below $100, comes in lower than April. When the next Fed meeting under Kevin Warsh clarifies whether the new chair will actually follow through on the rate hike the market is pricing. When the industrial demand data for Q2 shows whether the AI and solar demand story is actually softening, or whether it is continuing to accelerate as the CAPEX commitments suggest. Let me close the analytical section with the single most important data point of the entire week, the one that the mainstream financial press buried in paragraph 7 of their coverage of the paper price crash. the one that I believe is the most significant signal available to precious metals investors right now. The People's Bank of China just made its largest gold purchase in 17 months, in the same week that 5 simultaneous bearish forces drove gold to its lowest level since March. In the same week that UBS cut the silver deficit by 75%, in the same week that retail investors were watching their paper positions drop and questioning the entire bull thesis. In that exact week, China's central bank made its largest gold purchase in 17 months. Let me put that in context. The PBOC is not a momentum trader. It is not a hedge fund chasing short-term price movements. It is the central bank of the world's second largest economy, an institution with full visibility into China's own economic trajectory, its reserve diversification strategy, its geopolitical risk assessment, and its long-term view of the dollar's role as the global reserve currency. When the PBOC buys gold in size at $4,183 per ounce, at a level 5% below where gold was trading 4 weeks ago, it is making a statement about where it believes gold's value lies relative to the dollar-denominated assets it is choosing not to buy instead. And the statement is this. At $4,183 gold, with 5 bearish forces hitting the paper market simultaneously, with retail investors questioning whether the bull market is over, the world's most sophisticated sovereign buyer of hard assets decided that this was the moment to make its largest purchase in 17 months. Not to reduce its position, not to hold, to increase, aggressively, at the exact bottom of the paper price correction. This is the classic divergence between smart money and paper market noise. The PBOC is not reading the CPI print and selling, it is reading the structural reality, the dollar's reserve currency status under sustained assault from geopolitical realignment, the de-dollarization trend that has been building since the Russia sanctions, the negative real rate environment that persists even in a rate hike scenario because inflation is running above rates, and deciding that $4,183 gold is cheap relative to that structural reality. Physical dealers seeing firm premiums and steady retail accumulation. The PBOC making its largest gold purchase in 17 months. These are not isolated data points. They are 2 independent signals. One from the retail physical market, one from the world's most important sovereign buyer, saying the same thing at the same moment. The paper price is wrong. The physical reality is different, and the gap between the paper price and the physical reality is the opportunity. Let me close with the complete framework because you deserve a precise, actionable picture of what today's divergence tells you about where this market goes from here. Gold is at $4,283. Silver is at $76. The paper market has been hit by 5 simultaneous forces this week. CPI, PPI, new hawkish Fed chair, failed Trump Xi summit, UBS deficit revision, and the paper price reflects maximum bearish sentiment on all 5 simultaneously. That is important. Maximum bearish sentiment on 5 independent variables simultaneously is not a stable equilibrium. It is a position that requires all 5 variables to remain simultaneously at maximum bearishness to sustain, and all 5 variables have resolution timelines that are shorter than the bull market's structural thesis. The CPI and PPI prints, by definition, are April numbers. May CPI drops in 3.5 weeks. May captures the first month where oil was below $100 for a significant portion of the period. May captures the beginning of the energy price relief that the war discount closing has been producing. If May CPI comes in even 0.3% below April, which the oil price trajectory alone suggests is plausible, the rate hike narrative weakens immediately. Kevin Warsh's first Fed meeting is June 16th and 17th. The market will spend the next 4 weeks determining whether Warsh's hawkishness is a genuine policy commitment or negotiating posture designed to anchor inflation expectations without actually hiking. His first meeting will clarify the rate path with more precision than any confirmation hearing can. And if his first meeting produces a hold, which is the base case given the growth risks of hiking into an already slowing economy, the rate hike fear that is currently embedded in precious metals prices partially reverses. The Trump Xi summit produced no deal, but it did not produce a breakdown either. Xi committed to assist with Iran. Trade talks showed progress. The tariff truce through November 10th remains in place. The industrial demand thesis for silver, the thesis that drove the ratio from 63 to 55 in 4 weeks, is not dead because one summit produced no announcement. It is delayed. Industrial demand does not turn off because a summit disappoints. It turns off when manufacturing orders are actually canceled. And manufacturing orders in solar, AI infrastructure, and EVs have not been canceled. UBS revised its deficit estimate, but UBS is one bank with one model built on assumptions that are maximally conservative given the current macro environment. The Silver Institute's structural supply-demand data has not been revised. The mine development timelines have not changed. The byproduct supply constraints have not eased. When the macro environment clarifies, when May CPI is lower, when Warsh's first meeting is behind us, when the next Trump-Xi conversation produces some deliverable, the industrial demand model inputs will be revised upward from the maximally conservative UBS baseline. And through all of this, while the paper market processes 5 simultaneous bearish forces, while analysts revise their models in the most pessimistic direction available, physical dealers are selling out. The PBOC is buying its largest gold allocation in 17 months. The structural buyers are accumulating at paper price discounts that the physical market does not validate. This is what the divergence tells you. The paper market has created a discount. The physical market has determined the floor. And the investors who understand the difference between those two things, who can hold through a 10% single session silver drop and a 5% 4-week gold decline because they understand the mechanism that produced the drop and the mechanism that will produce the recovery. Those investors are positioned correctly for what comes next. The physical market is right. The paper market is temporarily disconnected from physical reality. And the reconnection, the process by which paper prices catch up to the physical signal, is the move that the PBOC just bet its largest 17-month allocation on. This is Asian Guy. If this breakdown gave you the framework to read today's paper crash alongside the physical dealer signal and the PBOC accumulation, and understand what the combination of those 3 data points is telling you about where this market is headed, like this video and share it with one person in your life who is watching gold at $4,183 and silver at $76 and wondering whether to sell. Do not sell what the PBOC is buying. The paper creates the discount. The physical determines the floor. And the floor just got confirmed by the most important central bank buyer in the world.